Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. I can't even say hope you guys are in the best of spirits seeing the carnage in the stock markets. Ironical, isn't it? Seeing the velocity of fall in some mid-cap and small-cap stocks, I am reminded of an analogy which people use in the stock market. They say the markets go up in stairs but come crashing down in an elevator. Whenever the markets crash, there are two sets of views. One is buy the dip with the assumption that in the long run everything is going to be fine, while the other set of view is that you should not catch a falling knife. The reason why I believe you are giving your time to me by watching this video is if you can take something actionable home. So let me start with an analogy in the stock market. Stock markets are the only place where investors run away from discounts. Imagine if there is a 30% sale in Zara, not many of you would miss it. But if there is a 30% sale in the stock markets, there will be hundreds of narratives of the world ending. While I agree this is easier said than done, but history has suggested markets have always rewarded the brave. Buy when there is fear, buy when there is blood on the streets. Unlike every time when I give my views in a structured format, this time I thought let us have a Q&A session. After all, Gyan and all that is fine, but at the end of the day it is important to make money. What I will do is I will try to address some questions widely asked when the markets crash and what I believe you should do. As a disclaimer, please understand these are my personal views and reserve the right to be completely wrong. After all, in the stock markets, bhav bhagwan hai. So for any investor, 4 things must be addressed when he makes a decision to buy the stocks. 1. When to start buying. 2. Which sector to buy. 3. Which stock to buy. And 4. What valuation to buy the stock. Let us start with the first question. When should investors start buying? When markets fall, while it is pertinent to find out the reasons behind the fall, market positioning is the most important factor in my view. Every time when the markets are overvalued, they always latch on to a trigger. While in this case it was the Russia-Ukraine invasion and the resulting inflation in commodities, especially oil, the reason in December was the risk of Fed hikes. The point is, you should look at the valuations of the market to justify your buying. In our case, the reason why Indian markets are spooked is because of crude oil and the inflation pressure it will exert. A $75 to $130 rise in crude and rupee depreciating from 74 to 77 against the dollar add immense pressure. Now, let us look at the valuations. Nifty in Feb and March 2021 was trading at a PE ratio of 40 times historical. While I understand in the coming months there were earnings upgrades which got the PE ratio down to 26-27 times, however, isn't anything above 25 times ridiculously expensive? Also, if we remove metals and oil marketing companies from Nifty, that is, say JSW Steel, Tata Steel and Hindalco, along with the oil marketing companies like BPCL and ONGC, Nifty today is still trading at a PE of 26 times. The reason why I am removing this is because most of these cyclicals have single-digit PEs when the cycle is at peak. This distorts the consolidated Nifty PE as over a period of time when the cycles turn, PEs will definitely rise. So coming back to the price action, even while the Nifty has corrected more than 15% from the highs, at present it is still trading at 20 times consolidated and 25 to 26 times with the cyclicals. And mind you, with rising crude price and inflation, I expect earnings downgrades and not upgrades. Demand will definitely be hit. Just to refresh your memory, in 2008, we were at a PE of 27 times at the peak. The average number to be looked at is 20 times. That's fair valuations. However, in my view, it is at or below 18 times the Nifty becomes attractive. So like how in March 2020, Nifty at the bottom had fallen to 16 times. We are still 10% away from being cheap. So in my view, what should investors do? While bottoms and tops are always made in hindsight, in my personal view, this is not the time to go full throttle. We have barely corrected 15% from the over-expensive zone we were in. Maybe 10% of your funds could be deployed at these levels. The next question is which sector to buy. Let me start with which sector not to buy. The FMCG sector, or what I like to call the crazy valuation sector, should be avoided at any cost. This sector is the first to get hit with rising inflation. Forget crude, every commodity is on the rise. Right from wheat to steel to copper, you name it, and it is at or close to all-time highs. While some companies like Jubilant Foods, Britannia or Asian Paints can pass on the inflation, but the markets have given it such high multiples that they are priced to perfection. Any small negative hammers the stock down. Can you imagine Asian Paints was trading at 100 PE before the fall? Jubilant Foods was trading at 90 PE before the fall. Insane valuations. I mean, everything is just priced to perfection. While I agree that they have fallen by 30% from the peak, but the other way to look at it is that over the past 2 years, all of them have more than doubled. Net, consumer sector is a total avoid for me because of their irrational valuations. However, a further 20 or 30% correction from here in these stocks would probably warrant attention, but not now. One more sector which temporarily should stay away from is the auto sector. This sector had become the poster boy of everything negative happening in the industry. Would you feel comfortable buying an additional car when the petrol price is at 100-110 liters in most of the cities and towns? As it is, the demand is extremely weak because of a rural slowdown. Add to it the fuel prices, they are also adding to the pain. From the company's perspective, raw material prices are on a boil. As I mentioned earlier, steel, aluminium, copper, all of them are surging. I am sure you must have heard about nickel doubling in just one day. For all those people finding shelter in EV stocks, a battery is made up by nickel, lithium, cobalt as its core components. Battery costs are expected to rise sharply. And yes, also, how can you forget 70% of palladium which is used in autos is supplied by Russia, which is an important component in manufacturing. Even if you look at valuations, stocks like Maruti are trading much above their average long-term P. I mean, why would you buy Maruti at a premium valuation when there is no growth visibility and no understanding about the electric vehicle pipeline? A lot of people ask me about the CV stocks. My view is that with rising diesel prices, the burden is going to be massive on freight operators, leading to muted demand. A strict avoid for the time being. Now again, if stocks like Maruti and Ashok Leyland correct by 20% more from here, the risk reward at that time will have to be evaluated. But the time for bottom fishing in auto stocks, in my view, can wait. Now that high PE consumer stocks and low growth auto stocks are a strict avoid, the next question is what sector to look for. Believe it or not, I am a big proponent of realty. I call it the Bhishma Pitama of Mahabharat. While real estate sector is one of the most hated sectors due to corporate governance, no economic cycle is complete without the outperformance of real estate. After all, directly real estate contributes 7% of GDP of India. I am sure indirectly it would be in double digits. Let me just give you some statistics which will blow your mind. The first data point is amazing. The market cap of all the stocks in the real estate space in 2008 as a percentage of total Nifty market cap was 8%. That is way too much in my view. Let's fast forward to 2020. The market cap of all the stocks in the real estate space in 2020 as a percentage of total Nifty market cap was 0.8%. Now, I am sure you are smart enough to figure out where I am getting to. 0.8% is grossly undervalued, while 8% is highly overvalued. Currently, my sense is with the current rise, we should be at 2% of the Nifty market cap. You will be amazed at the consolidation figure in the real estate space. The share of organized or big developers has risen from 17% in 2017 to 40% in 2020. That's a big boost to the listed players. Also, if you look at home prices, they are at 2016 levels. Trust me, no change in price for the past 5 years. There are so many other tailwinds in the form of, say, low interest rates and depleting inventory, which are massive boost to the sector, both from the demand and the supply point of view. So in my view, some real estate stock could double in the next 2 years. Real estate is too big an opportunity to miss. The triggers are in place for a re-rating. My suggestion is you should buy top quality real estate names with low debt and large land banks. This fall offers a good time to start accumulating. So guys, thank you for watching my video and I hope you find it insightful. Do write to me if you have any queries. Thanks again and happy investing.